We're back here at AT&T Park in San Francisco, live with two very special guests. Chris Byrne runs Goshen Investments, a New York-based hedge fund that he founded back in 2006. Original seed money coming from the help of Julian Robertson, I understand. It was named Hedge Fund of the Year in 2008 by Absolute Return magazine. He's got about $250 million under management. Also joining us, Paul Giordano. He runs Tamalpais Asset Management. Local boy here, has about $150 million assets under management, mainly in alternative strategies. So, gentlemen, there's almost anything we could start with here in terms of headline risk, the changes that we've seen in the marketplace. But talk to me about this return, some say, of risk on, risk off. Is QE2 in some way funding that?
In our opinion, it is, Margaret. We feel that the risk on, risk off trade creates a lot of opportunities because it tends to move all in indexes, and we feel that we can create alternative portfolios that can take advantage of this inefficiency that QE2 and the risk on, risk off trade create.
What are you seeing here, Chris? I mean, do you think this volatility is just short-term, or are you seeing this as an ongoing?
Well, I think it's here to stay as long as the Fed is going to continue to pump its balance sheet in this unprecedented experiment.
So does it stop in June?
I think there's a high probability of it stopping, and I think they're going to have to, because at this point, QE1 was a very important bailout of the financial system. QE2 has fostered junk bond speculation, out-of-control commodity prices, and it's coming home to hit the average American in terms of higher prices at the pump and higher food prices. So we're getting a backfiring of it now.
You hear time and again, because of the volatility, because of the difficulty, really, in some say placing big picture macro bets right now, that it's hard for some of the biggest guys in the business to stay in it. It's got to be tough on the smaller end of the scale as well right now.
We feel that it gives us an opportunity because we can be more nimble and we can move in and out of smaller positions. We can provide alternative and non-correlated returns to our investors that we feel the bigger firms can't do.
How do you do that?
What we do is we can be involved in issues that are 200, 300, 400 million in issue size and still create a portfolio that doesn't run into liquidity traps, where larger investors need to own larger percentages of certain issues, and we feel that those are the most efficient issues in the marketplace.
So the other thing that's happening right now, sort of in the back of your minds beyond all the headlines, is this New York trial. The biggest hedge fund insider trading case is playing out in a New York courtroom as we speak. Scrutiny is heightened right now. How is that changing how you do business, Chris?
It doesn't change how we do business at all. We have always maintained the highest standards. You're always concerned that there are individuals in the industry that have potentially gone astray.
You're not hiring more lawyers. You're not beefing up.
I think all of us are working on compliance, but we've never let down on our guard on compliance. And I've always been in compliant organizations, and that's at the heart of what we do. Look, we make money the old-fashioned way. We make our analysis. We make our bets. There are great opportunities in the world. There's no need to resort to these kinds of measures that these people are alleged to have taken, and frankly, it's a shame if they indeed did.
So does it change the so-called expert networks and the way that you look to access information?
It doesn't for us. We've never used expert networks. We always use publicly disseminated information from corporations to do our research.
So while we continue to talk about the fear of regulation, it sounds like you guys that's not front of your mind right now. What is?
We welcome regulation. We feel that it gives investors another level of confidence in the scrutiny that we are undertaking, and we realize that we have a large fiduciary responsibility to our investors, and we take that very seriously.
So when it comes to the kind of instruments you're looking to invest with right now, when we talk about increased volatility, does that mean you're moving away from equities? You're trying to involve more with perhaps option strategies, more with ETFs? Or what kind of instruments are you looking at?
We continue to use a combination of individual stocks and options. I would say that we are more active using options to hedge against the volatility. So that's
picked up of late.
Yes, we definitely have. I mean, you've got to adapt to the environment, and also the challenges are larger. Look at the magnitude of the problem in Europe. We've got a 10 trillion stock of debt outstanding from the PIGS. That's Portugal, Italy, Ireland. These 5 countries, Greece and Spain. The 5 of them have 10 trillion in outstanding debt. That's a huge amount, and they're in trouble. So it adds to volatility.
And this will be coming up later on in the week because you have that EU summit playing out in Brussels on March 24th and the 25th. Some look at particularly what's happening in Ireland and say, in some form, default has been priced in. You're starting to see that nervousness in the markets. Are you forecasting a default?
There is going to be restructuring in Europe. Whether they call it a default by another name, there's going to be write-downs of debt in Europe, and we think it's just begun. I think by the back half of the year, you're going to have the larger states pulled into it, and it's a very dangerous situation.
Big worry for you as well?
Yes, we feel that these are all volatility-creating situations, and that's what we focus on, trying to monetize volatility.
All right. So Europe moving from the back pages back to the front very soon. Thank you very much, gentlemen, for sharing your strategies right now.